Welcome back to Dinar Current, your source for all things related to the Iraqi dinar today. We dive in deep into one of the most critical factors shaping the dinar's future, the price of oil. You've probably seen the online hype about a sudden revaluation, but the real story is much more connected to the black gold that fuels Iraq's economy. So, let's break down exactly how oil prices drive the value of the Iraqi dinar first. Let's understand just how dependent Iraq is on oil. Imagine a country where over 90% of its government revenue comes from a single source. That's Iraq. This isn't just a number. It's the lifeblood of their economy. When oil prices are high, the country is flooded with foreign currency, primarily US dollars. This revenue pays for everything: public sector salaries, crucial imports, debt payments, and the massive undertaking of rebuilding the nation's infrastructure. More importantly, it gives the Central Bank of Iraq, or CBI, the firepower it needs to keep the dinar stable. But what happens when oil prices drop? The opposite. Government income shrinks, creating a massive strain on the national budget. This is where things get tricky for the dinar. Without a steady flow of oil money, the CBI's ability to defend the currency weakens, making it vulnerable to instability. This brings us to our second point: foreign reserves. Think of a country's foreign reserves as its savings account, filled with currencies like the US dollar. For Iraq, these reserves are almost entirely built from oil sales. The CBI uses these reserves to manage the dinar's value. When the dinar faces downward pressure, the CBI can sell dollars to buy up dinars, strengthening its value. When oil prices are high, these reserves swell, boosting confidence in the economy and the currency. It signals to the world that Iraq has the financial muscle to back its currency and pay its bills. Conversely, when oil prices plummet, those reserves start to drain. This limits the CBI's ability to intervene, making a devaluation more likely. A weaker dinar means imports become more expensive, leading to inflation and a higher cost of living for everyday Iraqis. So, you can see a direct line. High oil prices lead to strong reserves, which support a stable or appreciating dinar. Next, let's talk about the national budget. Every year, the Iraqi government creates its budget based on a projected price for oil. This is a huge gamble. If they budget for oil at $70 a barrel, but it ends up averaging 60, they face a massive budget deficit. To cover this shortfall, the government might have to borrow more money, cut public spending, or even delay projects. This financial stress puts immense pressure on the central bank. A government struggling for cash might push for a weaker dinar to make its oil exports more profitable in local currency terms. On the flip side, if oil prices are higher than projected, it's like getting a massive bonus. This surplus can be used to strengthen reserves, pay down debt, and invest in the country, all of which create a positive environment for the dinar. Now, we all know oil prices are incredibly volatile. They don't just move up or down slowly. They can swing wildly based on global events. Decisions by OPEC to cut or increase production can send prices soaring or crashing. A global economic recession can crush demand for oil, hurting producers like Iraq. Geopolitical tensions in the Middle East can disrupt supply chains and cause price spikes. And long-term, the global shift towards renewable energy poses a significant challenge to oil-dependent economies. This volatility is directly transferred to the Iraqi dinar. While the official exchange rate might look stable, the parallel or street market often reacts instantly to rumors and real-time changes in oil prices, reflecting the underlying economic anxiety. So, what are the clear benefits of high oil prices for the dinar? First, as we've said, it beefs up foreign reserves, giving the CBI the tools to manage the currency. Second, it boosts investor confidence. When Iraq's finances are strong, foreign companies are more willing to invest in the country, bringing in more capital and creating jobs. Third, it provides the funds needed for critical economic reforms. Fixing the electricity grid, modernizing the banking system, and building new infrastructure all require massive investment, which high oil revenue makes possible. All these factors together create a solid foundation for a gradual, sustainable appreciation of the dinar. But the risks from low oil prices are just as significant. If prices stay low for a prolonged period, Iraq could face a perfect storm. Dwindling foreign reserves would leave the dinar exposed. Growing budget deficits could lead to austerity measures, salary cuts, and public unrest. Inflation would spike as the cost of imported goods rises. The pressure on the CBI to devalue the currency would become immense. This is the nightmare scenario for dinar holders and the Iraqi economy as a whole. This deep connection to oil also means Iraq's fate is tied to global factors far beyond its control. When OPEC Plus decides to adjust production quotas, it directly impacts Iraq's income. When major economies like China or the US slow down, their reduced demand for oil is felt immediately in Baghdad. Even regional conflicts that do indirectly involve Iraq can disrupt oil markets and send shockwaves through its economy. This makes the dinar one of the most sensitive currencies to international news and events. This leads to the billion-dinar question. Can Iraq break its addiction to oil? The long-term answer to a strong, stable dinar lies in economic diversification. By developing other sectors like agriculture, manufacturing, technology, and tourism, Iraq could create new revenue streams that aren't tied to the volatile price of oil. This would make the economy more resilient, create private sector jobs, and reduce the pressure on the government budget. A diversified economy would give the dinar a much stronger foundation, making it less vulnerable to external shocks. However, this is a monumental task that requires security, political stability, and years of sustained effort. It's a marathon, not a sprint. In the midst of all this, the Central Bank of Iraq has a tightrope to walk. Its job is to maintain exchange rate stability, manage those precious foreign reserves, and keep inflation in check. Even with high oil prices, the CBI must be careful. Letting the dinar appreciate too quickly could harm the competitiveness of Iraq's non-oil exports, making them more expensive for foreign buyers. The bank's goal is not rapid, speculative revaluation, but a gradual, managed strengthening that supports sustainable economic growth. So, to wrap it all up, the future of the Iraqi dinar is undeniably tied to the price of oil. High oil prices provide the revenue for strong reserves, a stable budget, and growing investor confidence, creating the conditions for potential appreciation. Low oil prices do the exact opposite, risking inflation, budget deficits, and currency devaluation. While the internet is full of chatter about a sudden, life-changing revaluation, the reality is far more grounded in economic fundamentals. The path to a stronger dinar depends on stable oil prices, smart monetary policy from the central bank, and, most importantly, a long-term commitment to economic diversification. For anyone watching the dinar, the first thing you should be watching is the global oil market. It's the engine that drives the entire Iraqi economy. Thanks for watching Dinar Current. If you found this breakdown helpful, be sure to like this video, subscribe to our channel, and hit the notification bell so you never miss an update. See you next time.